If you've been following along in the series and you've gotten to the point where you've been growing your cash value, now you realize you can take these policy loans to have tax-free access to your money, but you're wondering, do I have to pay those loans back? And if I don't, who does? Today, we're gonna go over exactly that. My name is Daniel McCluskey. If this is your first video in this series, I recommend watching the whole thing from the beginning. The link is down below. Do I have to pay my policy loans back, especially as they begin to get bigger and bigger in the later years of my policy? Now, to best answer this question, we are going to put ourselves in a hypothetical situation where we had $1 million in cash value, we loaned out $500,000, and we're gonna say, do we have to pay that back? Might it be beneficial to pay that back if we're taking the fixed/zero wash loan, then the variable loan, and then third, what we're gonna look at in this video is what happens when we actually die and we still have that loan balance. So the simple answer for the fixed/zero wash loans and the variable loans, the vast majority of the time, is no, you do not have to pay those back. The only time you would maybe have to pay those back is if you were in a fixed account where somehow they were loaning you money at a rate and crediting you at a lower rate to where there's this negative arbitrage. Same with if you're in a variable and that variable rate is gaining at 6%, but your index keeps doing 0, and now you're losing money, so the loan balance is catching up to your surrender value. You would have to put in more money to pay that back. The only way that would happen is if, again, you're in the very later years and you've already accessed 90% of your money and you're not keeping an eye on your variable and standard loans. If that were to happen, this is why we always stress annual reviews. You can notice that and say, if that indexed to 0 and this loan grew another 5%, I have to put more money in and I can't afford or don't want to do that. Let's switch that to a zero wash loan. That's one way that you can avoid that. I would check with individual companies which ones can do this. The ones that I'm familiar with all do, but I can't speak for every product. Now, if you remember back to last video, we talked about an advantage of being able to just take a zero wash loan after some of those early policy years instead of just withdrawing, even though in either case you're not gonna make extra money. If you're just withdrawing the money, just the money that you put in tax-free versus taking a zero wash loan, in both cases you're getting the same amount of money and you're not making any sort of spread or arbitrage on that money. The difference is, and the reason why you might do that, as we mentioned last episode, is what if you run into some sort of money? You sell a business, you sell a property, you get a settlement, you get money passed on to you from an insurance policy from your heirs. Well, now you have room to put that money directly in as opposed to, well, putting it in some sort of taxable account. Or if you wanted to start a new IUL, well, now you might have to fund that over many years, as opposed to in this case, you can put it all in at once and get the money growing for you right away, tax-free. Now with the variable loans, the same deal is kind of the case. One of the big advantages of taking a variable loan is, well, if you do run into a lump sum of money, even though you're not planning to pay it back, you can put that in there right then and there. Now, lastly, what happens if I have these big loan balances, or even if it's a small loan balance, and I pass away? Is that going to pass on to my beneficiary through my estate, and they're gonna have to pay taxes on that loan or pay that loan off with their own money? What exactly is going on with that? In both cases, it's actually the same thing. So as we know, and we've learned from before, is our death benefit is always going to stay, unless you're past age 95 in some specific products, but it's always going to stay 5% ahead of our cash value. So in general, if we have $1 million in cash value, we're not going to have less than that $1,050,000 of death benefit because that's 5% ahead. So let's just say we're working with that case. $1 million in cash value, $1,050,000 worth of death benefit. Remember, our cash value is considered part of the death benefit. That's why the IUL can be so powerful. And the fees aren't like people say they are. Oh, the cost of insurance gets so much higher as I get older. Well, in this case, where you have the $1 million in cash value and the $1,050,000 of death benefit, you're only paying for $50,000 of insurance. That's why it's not expensive. That's just a side note. But in this case, where you have the million there and you have the $1,050,000, and you wanted to loan out, let's say it's $500,000. Well, if you pass away, the insurance company is not going to just wash that loan off and pay your beneficiary the full $1,050,000. Well, then they just lost $500,000. Why would they do that? Instead of double paying you or your family that money, what they're going to do is they're just going to take whatever the loan balance is, they're going to pay it off with the death benefit, and the rest of the death benefit goes to your heirs. So in this case, they would take $500,000 of that $1,050,000, pay off the loan, and then your heirs would be left with $550,000 tax-free to go to them and use as they wish. So that's it. First, we have our fixed/zero wash loans. I think they're typically a better option than withdrawing. Why? Because we have extra room to pay those back if we wanted to, but no, we don't have to. Same with the variable, we don't have to pay them back, but we have room to where if we get money, we can pay them back and get the money going for us tax-free sooner rather than later. And lastly, in either case, if we pass away, what happens? The death benefit pays off the loan balance and the rest of it goes to our heirs tax-free. Well, this is getting pretty exciting. We are really getting near the tail end of describing and learning about the nuances of the IUL. Now what we want to start considering that you've gone through these first 12 episodes is comparing it to other vehicles. So next episode, we're going to talk about what are the 4 key elements that I like to look for when looking for a prudent investment vehicle. So let's start there. That's going to be episode 13. Our next episode from there, we'll get into our historical returns. We'll look at comparing it to other vehicles and continuing down the path. I will see you in the next video. Bye-bye.